Canadian housing starts plunged 16% in August. What it means for the economy: Canada's housing market took a sharp hit in August 2025 as housing starts fell by 16%, according to data released by the Canadian Mortgage and Housing Corporation (CMHC). This decline is not only sharper than expected, but also highlights the growing challenges facing the country's real estate and construction sectors. The numbers behind the decline: July 2025, housing starts were reported at an annualized rate of 293,537 units. August 2025, the figure dropped to 245,791 units, marking a steep fall. Market expectations: economists had forecast housing starts at around 277,500 units, meaning the decline significantly overshot predictions. This unexpected drop signals that Canada's housing market, which has been under immense pressure from high interest rates and rising construction costs, is losing momentum faster than anticipated. Why are housing starts falling? Several factors are contributing to the slowdown: high interest rates. The Bank of Canada's policy of maintaining elevated interest rates to combat inflation has directly impacted mortgage affordability. Higher borrowing costs discourage developers from launching new projects and reduce demand from potential buyers. Rising construction costs, costs of labor, raw materials, and regulatory compliance remain stubbornly high. For many developers, the profit margins on new housing projects are shrinking, making them hesitant to break ground. Economic uncertainty: with broader concerns about slowing economic growth, developers are wary of oversupplying a market where buyers may be reluctant or unable to purchase new homes. Supply chain issues: persistent delays in acquiring building materials continue to create bottlenecks, further discouraging timely project initiations. Broader economic implications: the decline in housing starts is more than just a real estate story. It has direct implications for Canada's economy. Impact on jobs: the construction industry is a major employer. A slowdown in new projects can lead to reduced demand for construction workers, engineers, and suppliers. Housing affordability crisis: ironically, fewer housing starts mean that supply growth slows down. With demand still high in cities like Toronto and Vancouver, this could worsen affordability challenges. Investor sentiment: real estate has long been seen as a safe haven for Canadian investors. A prolonged slowdown could reduce confidence in the sector and shift investments elsewhere. Economic growth: since housing contributes significantly to GDP, this sharp drop could drag on overall economic performance in the coming quarters. What's next? Policymakers face a difficult balancing act. On one hand, the Bank of Canada needs to keep inflation under control, but on the other, high interest rates are strangling housing supply.